as an investor, you need to figure out what your edge is over others whom you are competing with in the market. And there are three main types of edges when investing: informational, analytical, and behavioral. In this video, I'm going to be discussing the edge that retail investors actually have a shot at and how to implement that in your individual investment style. Now first, let's start with informational. And back in the day, Warren Buffett used to find his stocks through newspapers and books. He would have to conduct his research by physically going to places and finding the information that he needed. This gave Buffett a significant informational advantage, as many people were not able to or did not want to invest the time and effort required to discover companies worth investing in due to the hassle and research involved. This practice of finding stocks at a cheap valuation by constantly researching companies was a very effective strategy for the time. However, with information now readily available from your pocket and the average person having access to nearly the same information that a professional fund manager may have, this edge that Warren Buffett speaks of is deteriorating and might even be gone. Although there is little room nowadays to outperform because you have access to information that others don't, the informational edge can still be a tool that retail investors can use. I will say though, it is more important about what you do with the information rather than having information that others don't. And let me explain. With most active investors, we are all consuming majority of the same information, whether it be analyst forecasts for companies, interviews done by fund managers on CNBC, conferences held by Bloomberg, etc. But the real advantage doesn't come from having information that others don't. It's by taking in this information and not acting on it. And that gets into a different edge, but we'll get there in a minute. Many managers and retail investors believe in acting quickly when there's new information, when in reality, weathering certain market sentiment shifts and doubling down on your highest conviction bets when the market and news cycle is doing nothing but bashing on those may be the key to your outperformance. Not every piece of news or earnings report is worthy of buying or selling whatever stock or index fund it may be. And knowing when to hold back because of new information is a key to outperformance that many famous investors have achieved. And that gets us into the analytical edge. And the analytical edge means that when everyone is looking at the same thing, you are seeing something different. And this edge requires a lot of very in-depth knowledge of the markets and business in general. Because you have to remember that there are people out there who have 20 years of experience, who have a full staff of well-paid, highly educated people who are doing nothing, pouring themselves over the stock market and certain companies. And they are trying to find the same opportunities that you are. So those are some of the people that you are competing against. But a good example of how investors were able to accomplish this is with Tesla over the past 5 to 10 years. Wall Street and the majority of news outlets were very negative on Tesla for many years, as Wall Street was shorting the company heavily with the belief that they would fail and dissolve into bankruptcy. The news echoed this sentiment with negative news segments and short reports about why this company was destined to fail. Despite big money and the majority of big influential investors being incredibly bearish on this stock, this did not stop certain retail investors from buying this company at insane lows and then profiting more than 10x on their investment over just a couple of years. Another great example of the analytical advantage a retail investor can have over institutional money is with Bitcoin. It has been misunderstood by institutional finance since its inception practically, but has also outperformed all other asset classes by a wide margin since then. Regardless of your opinion about Bitcoin, you have to acknowledge its consistent outperformance against the vast majority of portfolio managers. Many institutional investors didn't even give this asset the time of day, while they lumped it in with the rest of useless altcoins that exist. For those investors who took the time to read the Bitcoin white paper regarding Bitcoin's creation and its value proposition to its holders and users and miners, they were rewarded handsomely and outperformed all other asset classes and nearly all professional investors. These stories show that although markets are typically well-informed and highly analytical, they don't get everything right. And with a little luck, assets and companies like these can succeed and offer wide outperformance for retail investors. Now, the final and most important edge, in my opinion, is behavioral. And this attribute can be one of the most advantageous strategies for retail investors, as it seems to be one of the hardest things to control for institutional investors. The reason it is often hard for institutional investors and money managers to control the emotional aspect of investing is because they are often accountable to people who are not well versed in this world and in the investment philosophy and strategy that can lead to outperformance. And this can lead many managers to have certain goals in the short term at the expense of the long-term returns of the portfolio. For example, if their portfolio drops down due to volatility, some will call or email their manager to ask what's going on in kind of a frantic way. And at a certain point, if the short-term volatility gets too bad, they may threaten to remove their money from the firm entirely. And this can put a lot of stress on managers and make them sell out of positions at inopportune times. And if you don't believe me, take a look at Terry Smith and Amazon recently, as well as Bill Ackman and Netflix, where both investors saw their investments dropping like a rock in the short term, and because of their incentives and the emotions involved, they sold out on the lows and both missed large run-ups. You can also think about the multitude of investors who got Meta so wrong in the last 2 years. And I think it's fair to say that a 76% drop because of their investment in the metaverse was an extreme overreaction. And the investors who were able to hold their position and even increase it at the lows have seen over a 270% gain from them. And some of the problem is that many retail investors believe that these opportunities are only for the pros. But that could not be more false. And an example of that is, as a college student with petty cash like myself, I had the foresight to hold my shares through this drop and actually triple my position when the stock was under $100 a share. I don't say this to brag, because trust me, I don't have hundreds of thousands of dollars to invest, but only to prove that anyone at any scale has the ability to outperform the market if they can control their emotions during market turmoil. And when I give you those examples of how Terry Smith and Bill Ackman messed up because they were being somewhat emotional in their investment picking, I say that because they are not your average retail investors. They are some of the largest investment funds in the entire world, and they are making these mistakes. And it is something that we as retail investors can take advantage of by having a better temperament and not having the pressures of being accountable to outside money and uneducated clients. And another key part is that volatility is often a key aspect of the behavioral edge that retail investors can endure, but others may not. Certain investments, like those with a large amount of volatility, or as much as the investment community likes to call it, risk, can be just that. Many investors are beholden to short-term goals, which means they simply cannot invest in assets that have that level of volatility. Even though they have less risk in terms of permanent loss of capital, they still have increased volatility, which means they just can't invest in it. And since many cannot partake in those investments, this ends up leaving these opportunities for retail investors, as well as family offices and smaller funds who are able to. Being that it is far more difficult to gain an edge over institutional investors by having more information or being more analytical, the best way that retail investors can succeed is by controlling their behavior and removing emotions from their investments. Now, in conclusion, investing is not an easy task, and that's why so many people opt to invest in index funds rather than try their luck in the public markets. And that is why it is so important to understand what gives you your competitive advantage over the trillions of dollars that are flowing in and out of the markets every day. You don't have to be the smartest person investing or the one with dozens of expensive subscriptions to have a chance at winning at this game. Maybe it's a combination of deep understanding of a certain industry or an iron stomach when it comes to volatility. Who knows? But you need to determine how you're going to get ahead over other investors and really take advantage of that. Now with that, that's all I had for you in this one. Thanks for watching. I'll see you in the next one.